The purpose of this video is to give you an introduction to the first project milestone that will be due in Module 3, and also provide or give you a demonstration of how to use the workbook that has been provided for this project to complete the required components of the task. So where we want to start when we look at this first step in the final project is the Milestone 1 Guidelines and Rubrics document. So this document is going to tell you not only what you're completing for this week or for this first milestone submission, but is also going to provide you with a copy of the grading rubric. So the grading rubric for the assignments is always going to be a very important piece for you to visit, as it will give you the details on exactly what is required for you to perform your best on each assignment. So our guidelines tell us that you were recently hired as an entry-level bookkeeper for a service business that recently opened. This is the first month in operation for the business, and your first task is to record business transactions for their first month using the source documents and transaction data the owner will provide to you. So this transaction data is going to be found in the accounting data appendix. Because this is a small business that does not employ computerized accounting, you will apply the accounting cycle in Excel to record transactions and generate financial reporting results for the owner. So we have provided a workbook for you already formatted for Excel. So essentially, you're not going to have to format a workbook. You're just going to be entering the data into the appropriate sections or tabs in the workbook provided. So for this first submission, you are going to prepare journal entries that are accurate and fully reflect the appropriate information or effect of each transaction on specific accounts. Then you're going to transfer those entries and post them to the appropriate T accounts, and then use the T account balances to prepare the unadjusted trial balance. And those are the 3 steps required for this Milestone 1 submission deliverable. So our next step is going to be taking a look at that accounting data index. So this accounting data index is going to give you all of the transactions for the month that you're required to record for this project. So as we look at the accounting workbook for the project, I want to encourage you to be sure you take a moment to review the chart of accounts. That's the first tab in your workbook. This chart of accounts will be particularly useful for you, as it's going to give you a listing of each account that you will use in recording transactions for the project. So narrowing down the different account options is going to help you identify the affected accounts for each transaction. And you'll notice as well that your chart of accounts is organized based on the classification of the affected accounts. So this classification will be very handy for you in using the T account infographic that's provided to you in the course to follow the rules of debit and credit based on the classification of the account and whether or not that account is increasing or decreasing. So we'll also come back to this as we look at or demonstrate how to record individual transactions and using these rules to determine which account will receive the debit and which account will receive the credit in each entry. So after you familiarize yourselves with the accounts that you'll be recording to, your first step is going to be journaling these different transactions. So notice we've provided you some tips here. The debited account is always recorded first, the credited account recorded second. So we'll take a look at that. For every entry that we enter here, we will always record to the debited account first and the credited account second. Your debits and credits for each transaction will always equal or be in balance. And you'll notice too, and this will actually be one of our first examples here, that there can be compound entries in which 2 accounts receive a debit to 1 equivalent credit, or vice versa. A reminder to be sure to use your chart of accounts to identify specific accounts affected. Each account you record is already listed and organized by the classification of the account. So just to provide a couple of examples, let's go back to that accounting data index and see what our first transaction is. Our first transaction was on May 1st. On May 1st, the owner contributed $50,000 in cash to the business and borrowed $50,000 cash through a 5-year loan at the local bank to get the business started. So first we have to analyze this transaction, think about the effect on the accounting equation, and identify what is affected. Well, obviously cash is increasing, both from that contribution of capital by the owner and from the cash proceeds of the loan. But we're also seeing liabilities affected, right? Because 50,000 of this is becoming a long-term payable. And we're also seeing capital increased because we're seeing that $50,000 contribution in cash from the owner. So we have noted to ourselves, of course, that in the chart of accounts, there's a cash, there are liability accounts, there's also an owner's capital account. Right, our next step is going to be determining what is debited and what is credited to record this as a journal entry. So if we go back to that T accounts infographic and we say, okay, we know cash is affected and cash is increasing, right? Cash is an asset, and assets increase on the left side or with a debit. We know that our liabilities or our debts are increasing, right? So liabilities increase with a credit or on the right side. And likewise, our owner's capital is increasing and capital increases on the right side. So what we're seeing here is that cash, the asset, is going to take the debit, and liabilities and owner's capital is going to take the credit based on those rules of debit and credit. So now we start to record that. The date goes on the debit line of the transaction. So we are debiting or increasing cash by $100,000. Sorry guys, I'm minus a zero. And then we are crediting liabilities. So let's jump back and see what our liability accounts are right quick. We've got 3 liability accounts. We know this is not tied to wages, right? So what's the difference between notes payable and accounts payable? How do we know when to use those? Well, just to clarify, accounts payable is much more representative of a short-term obligation. So perhaps we received supplies and we're waiting on an invoice from that vendor to pay what is owed. That's an accounts payable, something that will likely be paid within the next 30 days, for instance. Notes payable is more representative of a long-term debt agreement like that note at the bank. So in this case, I would use the notes payable liability because it's more indicative of the term of this note or the type of this note. So that's going to be notes payable. Takes a credit for 50,000, right? Because we borrowed 50,000, and then the owner's capital is going to take the $50,000 increase as a result of the contribution of the owner's personal funds. So now that we've recorded our entry, we know that our debits and credits are in balance, right? Our debited account is recorded first, credited accounts are recorded second. Our next step is going to be to transfer each individual debit and credit to the specific account that is affected. So as a result of this transaction, the cash account should increase by $100,000, right? So this is where we go over to the ledger accounts. We find the cash account and we record that increase or that debit just like we saw in the entry, right? If it's a debit in the journal entry, it's a debit in the T account. If it's a credit in the journal entry, it's a credit in the T account. So we're going to show that $100,000 increase in cash on May 1st. We know we had a $50,000 credit to the notes payable, right? Increasing the liability on May 1st as well. And then the $50,000 increase or credit to owner's capital with that May 1st transaction. So as you can see, I'm entering on the same side and just dating next to that entry. So as you can tell, or as you might notice looking at these T accounts are already set up to basically do the math for you. So you want to focus on making sure that all the accurate debit and credit or increase and decrease information is input here, and then your account itself will take that increase and decrease information to show you what the current balance is of the account. You'll notice too that some accounts have debit balances, whereas other accounts have credit balances. So once we've posted all of our journal entry information to the specific affected accounts and we have final account balances, then we'll transfer debit account balances into the debit column of our trial balance and credit account balances to the credit column of our trial balance. We left some notes for you in the T accounts page as well. First, it says don't overthink it. That's easy to do. You're just posting each debit and credit from your journal entries to the account that you identified in the entry. These accounts are set to calculate your balances for you, so be careful not to delete this information at the bottom that totals your columns and then provides you with your balance. So let's take a look at another transaction before we see how our results here are going to relate to that final step or the trial balance. So let's jump back over to the accounting data appendix. It says on May 1st, the owner paid May rent for the new office in the amount of $1,500. So once again, we have to stop for a moment and analyze this transaction and what the effect of this transaction would be on the accounting equation. We know cash is involved because we are paying cash, right? But in this instance, cash is going to decrease. We also know that rent is involved, and rent is an expense for the company, right? So now that we've identified, okay, rent and expense is involved and is going up, and cash is an asset, it's involved, it's going down, we're going to move over to those rules of debit and credit to make sure we accurately identify which account is debited by the $1,500 transaction and which account is credited. You'll notice that expenses increase or go up on the left. So our rent expense account is going to take the debit. Cash is an asset, and assets decrease on the right or with a credit, so cash is going to take the credit. So that's exactly how we're going to record this May 1st transaction. Rent expense is taking a $1,500 credit to show the increase in costs. And cash is taking a $1,500 credit to show the decrease in the cash account. So we want to transfer that data to our ledger accounts. And here you're going to notice how the debits and credits work together in these accounts. We had a $1,500 credit to cash on May 1st. So here you see that our total increases or debits to cash minus our decreases to cash is going to change that cash balance. So after this transaction, our cash balance went from $100,000 debit balance to a $98,500 debit balance. And then find our rent expense account and show that debit to rent expense on May 1st to get our balance. So don't worry about this just means the hashtag signs just means that our cell is a little small. So if I make it bigger, then it will show that full figure in the cell. So that's the process after we've recorded each of the transactions with equivalent debit and credits, right? We're going to post each debit and credit to the ledger accounts, and that's going to give us balances for each account. Now, the last step is just going to be checking for balance. Something else that this worksheet is going to do for you is going to pull your ending balances over from the T account ledgers into the unadjusted trial balance. And once all of those entries are posted, we should have balance in the unadjusted trial balance. So this is another spot where you don't want to modify the formulas that are built into this particular trial balance because it will pull for you. But if you did manage to do that, really all you've got to do is come over here and say, okay, the ending cash balance is this. It's a debit, so I'm going to put that here on the debit side. So you're just taking each individual debit and credit balance, and we should be in balance. This unadjusted trial balance is our first stop check for accuracy as we follow through the accounting cycle. Now, what this can tell us is whether or not we're in balance. So we know if we're out of balance, we definitely have a problem. And as accountants, our goal is to generate accurate and honest financial information so we don't move forward from this point until we find and we fix those errors. It can't tell you, however, if you accidentally recorded to the wrong accounts, but still recorded in balance. So that's where you stop with this first submission, is in the unadjusted trial balance. If you're not in balance, you want to find the error. Once you feel confident about your results, it's time to submit. But note that you will receive specific feedback on these first three steps. These first three steps that you're completing with this milestone 1 submission. So when you get your feedback, you're able to return to any errors that you may have made in that entry and posting process to arrive at correct balances so that you can have those correct balances when you begin to prepare the financial statements for the second milestone submission in Module 5.